Hi friends, welcome to the BFM crash course day number 4, and our today's topic of discussion is unit number 23, which is based on Treasury Risk Management. Every important points related to this topic is being explained in the form of diagram, flowchart, so that each connection become clear in your mind and you can easily answer any type of question asked based on these topics. So let's get started. The first kind of understanding that we should have is regarding the Treasury operation flowchart, as you can see. So friends, here we decode the entire structure through a simple, easy to understand flowchart. Let's begin with the treasury structure. As you can see here, let's begin with the treasury structure. So friends, which is broadly divided into basically three main areas are there: front office, back office, and mid office. Right. So mid office I will talk about in the latter part of this video. So what happened in the front office? Let me explain what happened in the front office. So front office is like action zone. We can call the front office as the action zone. That means where interbank deals are executed. You can see it execute the interbank deals, first point. And whether it is forex, whether it is securities, lending or borrowing, right? Think of it like a command center where actual trading magic happen. So you can think of this forex as command center, right? And where the actual trading magic happen. Further from here, two key functions unfold. What are the two key functions? The first is the execution of the deal, which means the deal initiated are put into action. So whatever deal you have initiated, that is put into action here. That is called execution of deal. And the second is called team structure. Every great system need a stronger team, right? This includes chief dealer. Chief dealer is a part of front office who lead the charge, and a specialized dealer who focus on a specific market segment. Right, so these are the two different team structure under the front office. You must know it that it consists of chief dealer who lead the part, and there are specialized dealer. Next come managing the treasury book. Here you can see how can we manage the treasury book. So friends, all executed deals are recorded and managed properly in the treasury book to track performance and risk exposure. Right. So this management give rise to two types of books. Two types of books are basically there, right? The first is called the trading book. You know what is the meaning of trading book? So it deals done on the bank on behalf. So those deals which are done on bank on behalf, that is called trading book. That is called trading book. Deal which is done on bank on behalf, that is called trading book, right? Aimed at earning profit. What is the main aim? Main aim is the earning profit, earn profit. That is the main aim. Right. The next we have is called merchant book. Merchant book means what? Deal executed on the behalf of clients, and it is based on internal requirement. So basically, trading book means what? Deal done, right, on the bank on behalf, and it is aimed at earning profit. While merchant book means what? The deal executed on the behalf of clients, right, and this is based on the internal requirement. So that is all about the front office which you have to know, right? Execution of deal, team structure, treasury book management, whether it is trading book, whether it is merchant book, right? What trading book store, what merchant book store. Now friends, let's move to the back office. At the bottom you will see, right? Back office. So back office is called silent powerhouse. In single word you can say they are like silent powerhouse. Why we call them silent powerhouse? Let me explain. See, this time ensure that all the deals are confirmed and settled within the bank approved exposure limit. You see, all the deals, whatever deals is there, they are confirmed and they are settled within the bank approved exposure limit. So they also handle the rate verification to check the deal accuracy. Yes, to check the deal accuracy, how much accurate the deal is, they also undergo the rate verification. Furthermore, compliance responsibility. They ensure that everything aligns with the internal and the regulatory norm. That is called compliance responsibility. So in nutshell, we can say that front office execute and manage the deal, while the back office confirm, back office settle, back office ensure that compliance. So together they form the core of the bank treasury operation, right? And furthermore, we have mid office also. In addition to the front office and back office, we are going to talk about in the latter part of this video. Now friends, let's come back to this particular flowchart diagram. This will help you remember the things for a longer amount of time, and once you solve MCQs based on them, you will feel confident. So friends, let's dive into a critical control mechanism in forex trading, that is called FX trading limit. Yes, we are talking about what? We are talking about FX trading limit, right? Their objective, their types. First thing first, why do we need trading limit, right? So what is the objective of them? See, the core objective is to limit potential loss. That is our main objective. That to limit the loss, limit the potential loss to during the adverse market condition. Yes, so the main objective is to limit the loss during adverse market condition. You can think of them like protective shield. Yes, they are like protective shield. Why I call it protective shield? Because this is the one that ensures that bank does not go off the rail when the market gets rough. When the market gets rough, bank does not go off the rail. This is what is ensured by forex trading limit. If you look at the types of forex trading limit, on one side we have open position limit. What is the meaning of open position limit? See, they restrict the volume of open currency position a dealer can hold at any time. As the name itself suggests, right? Open position limit. That means they put a restriction. They put a restriction on the amount of open currency position a dealer can hold at any time. That is called open position limit. Furthermore, we have called a stop loss limit, which means the emergency break. We can call them like emergency break. We will talk in detail about this. We can call them emergency break, right? If the loss reach a predefined point, this position is exited automatically to cap further loss. And then we have something called deal size limit, which means it set a ceiling on the size of individual trade. That means it set a ceiling, it set a cap on the size of the individual trade, right? On the size of individual trade, it put a ceiling. But remember, this is mainly for proprietary deal. Remember, this deal size limit is mainly for proprietary deal, not for covered merchant deal, right? If you look at the open position concept here in the right side, you see, and you can see. So what is the meaning of open position? This refers to a situation where a bank hold a currency position open. So see, suppose the bank hold a currency position open, right? Means why? Expecting to gain from the forex movement. Yes, bank is expecting that it will gain from the forex movement. That is why bank keep its position open. That is called open position limit. But it comes with the onset of risk. Obviously, the risks are there, right? Bank have to keep the open position. Why? The bank has kept the open position expecting to gain from forex movement, expecting the forex gain. But yes, there are some lead risk also in this case, like market may not appreciate as expected. You can see the first risk is no appreciation. The second risk is it carry cost, and the third risk is the rupee fund cost all add up. Now friends, then we have something called, so we have discussed the open position, now discuss the forex position. So whenever you see the open position, just remember this key point, that bank hold a currency position open expecting to gain from the forex movement. If you look at the forward position, this involves future forex commitment. Remember, it involves future forex commitment, right? That is called forward position. So two major factor comes into play. The first is called position sizing. What is the meaning of position sizing? Means how much exposure should be taken. And the second is called currency anticipation, which means what direction will the currency take. So remember, forex forward position regarding future forex commitment, and two major things are there: position sizing, which means how much exposure should be taken, and currency anticipation, which means what direction will the currency take. So to summarize, these FX trading limit are not just compliance tool, they are the bank safety net, balancing profit potential with the risk control, a must known for anyone serious about forex treasury. I hope we have discussed the major kind of forex trading limit in this particular slide. If you really think that it was useful for your understanding, please hit that like button. Now friends, let's move to the overview of the financial position management. So let's decode a financial position management framework, a crucial system that keeps a bank forex and treasury exposure in check when within regulatory comfort zone. First of all, types of the position limit. Let me zoom a little bit so that this picture become clear. First of all, let's talk about the types of position limit. To begin with, bank operate under position limit. Yes, both currency wise as well as aggregate INR term. So see, currency wise also there are position limit, and aggregate INR there is also position limit, right? For example, if a bank is dealing in USD INR, the net position is closely monitored, right? If suppose bank is dealing in USD INR, the net position is closely monitored, right? And if there is any overnight position, try to understand, if there is any overnight exposure, let me write down, if there is any overnight exposure, what will happen? In that case, that require prior approval from RBI. RBI nod is required, right? That is called, if there is any, right? If there is so basically we are talking about the types of position limit. Bank is dealing in USD INR, the net position is closely monitored. Any overnight exposure, then what? That require prior approval from the RBI for overnight limit. Now if you look at the position limit, just I told you currency limits are there, and aggregate limits are there, right, and RBI nod is required. If you look at how to measure the position limit, these limits are not random, they are measured meticulously, again in INR value, covering both individual currency and the overall position, right. That is the point. Net position are tracked continuously, right, they are tracked continuously. And regulatory nods are must for extended exposure. If you want to extend the exposure, you need to get a nod from RBI. If you look at the swap deal risk, here you can see what is the meaning of swap deal. See, here is where the things get interesting. If a bank buy in a spot market and sell in forward market, it technically avoids forex exchange risk, because it is buying in the spot market and selling in the forward market. So basically it is technically what it is doing, it is avoiding the foreign exchange risk, right. But there is a catch. What is the catch? The catch is that the interest rate gap risk. This is where time gap comes crucial. The longer the gap, the higher the risk. Obviously it is not exposed to foreign exchange risk, but yes, it is exposed to interest rate gap risk. The higher the difference, the higher the time gap between buying and selling, the higher the time gap, right, the higher the risk. That is interest rate gap risk. So you can see that this swap deal risk is not just like that, it is no risk is there. Yes, risk is there. The risk is interest rate gap risk is there. Now there is a concept called gap limit concept. What it is? See, gap limit apply to time bucket. We have already discussed time bucket in the earlier part of the lecture, right, in the previous lecture. So what is the meaning of gap limit? So whenever you see this word gap limit, basically it applies to what? It applies to time bucket, right? It applies to time bucket. So say overnight, 1 to 7 days, etc. So positions are revalued daily basis or monthly basis, and bank must make sure that their AGL, what is the meaning of AGL? AGL means average gap limit. So their AGL, or the average gap limit, stay within a cap, which is how much? Which is linked to their capital base. That is called average gap limit, right? That is called gap limit concept. I told you now that if gap limit increase, then obviously it is exposed to interest rate gap risk. So to curtail that, to avoid that, right, AGL has been placed, which is maximum 6 times the capital base, right. This question is frequently asked. What is AGL? Average gap limit. Now one more thing, capital requirement. See, here is the golden rule. Bank must maintain 9% capital buffer. It must maintain 9% capital buffer. But on what? See, on what? Either on their NOPL. What is NOPL? That is called net open overnight position limit. So this question is most frequently asked. Net open, we are covering only that much which is important from examination point of view. I have seen the last 5-year paper. Based on that analysis, I am providing you the content. So net open overnight position limit, that is called NOPL. Full form must be known to you. Net open overnight position limit. So bank must maintain 9% capital buffer either on their NOPL or the balance sheet date position. Either of both of them. NOPL or balance sheet date position. Whichever is higher, they should make 9% of that. Then look at the control in securities trading. So it does not end with forex. Even security trading is tightly controlled. Yes, it does not end with forex. Security trading is tightly controlled. Bank follow a strict limit based on deal size, maximum security, number of security, holding period, right, credit rating, bond maturity, and everything else. So these checks keep a speculative risk under control and ensure portfolio stability. So to conclude, financial position management is like the bank health monitor. It ensures that no trade, no swap, and no position spiral out of the control. Risk is real, but with the right limit, it is manageable, right? So that is the point which we have just studied now. So friends, what we have discussed just now, this was regarding the overview of the financial position management, right? So we have talked about the how many position limits are there, how to measure them, what is swap deal risk, what is gap limit concept, how to measure the capital, and how to control, what are the control in security trading. Now let's understand stop loss limit. In this particular slide, everything will be clear regarding the stop loss limit. So friends, let's dive into one of the most crucial risk control tool in trading, that is called stop loss limit. You can think of it like safety net. It protects you when the market turns against you. What is the mechanism? So you can see mechanism. So stop loss is a kind of preset limit, right? It is a kind of preset limit. For example, imagine a trade hit $5,000, right, loss. Suppose a trade hit $5,000 loss. That is the threshold. At that point, mandatory exit is triggered. At that point, what happened? Exit is triggered. Mandatory exit is triggered. It is considered a management violation, and the action follow first, right? And if it not followed, try to understand. If it is not followed, So suppose the trade hit $5,000 loss. That is the threshold. That is the stop loss limit. At that point, mandatory exit should be done. If it is not followed, then what will happen? Then management violation and action follow fast. That is the point. I hope that makes sense to you. Now, if you look at the monitoring responsibility, that means who watches the limit. So here is the internal control at work, right? Internal control. So basically, the back office in charge of. It is in charge of the back office. So back office is in charge of tracking the stop loss trigger, valuing the position, alerting the front office. This act like second layer of check to ensure that nothing slips through the crack. Then we have something called multi-level framework, which means stop loss is not just a one-time rule. Rather, it is structured at multiple level, per deal, per day, per month, and even an annual aggregate. Which means this ensures that risks are controlled at every step, micro level as well as macro level. I hope every aspect we are taken care of in this particular slide. That is the beauty of this, our crash course, that you are able to cover the entire unit in just 20 to 30 minutes. Right? There's no long boring lecture which takes more than your time. Right? Our main focus is on solving MCQs. That is why 80% of your time should be devoted to solving MCQs and just 20% to this. Now friends, let's look at the application in security trading. Every aspect we have, which you will see in book 2 to 3 pages, have been covered in just single page. If you look at the application in the security trading, so when you are trading volatile or illiquid asset, volatile or illiquid asset, whenever you are trading, the need for a stop loss become even more intense. Yes, if you are trading volatile or illiquid asset, the need for a stop loss become very intense, right? Very much required. Why? Because risk is monitored using some tools like MTM, mark to market, value at risk, duration analysis. These are the tools through which risk are monitored. Now what is the purpose of it? What is the purpose of a stop loss? Because it is simple. It's your last time line of defense. You can call it line of defense, right? It caps your potential loss, right? It caps your potential loss. That is the first thing that it do. Or the other thing that it do, it avoid emotionally driven holding on to bad trade. Yes, it avoid you holding position which is a bad trade. Think of it like emergency brake in a high speed trade. And if you look at the trader psychology versus risk management, so let's face it, traders are human, but emotions should not rule decision. A stop loss force discipline. Hit the limit, say rupees $5,000, say $5,000, you must exit. No excuse. If you don't, strict management action is enforced. That is how risk is kept in check. And if you look at the valuation requirement, so lastly, for a stop loss to work, position must be marked to mark daily. This is very, very important, right? Only then can limit be accurately enforced in real time. So position must be marked to market daily. Only then, the limit can be accurately be enforced in real time. So to remember, a stop loss is not about avoiding risk. It's about managing it smartly. It's not a trading tool. Rather, it is a discipline enforcer, a risk barrier, and your profit protector. Remember this. These are the keywords regarding the stop loss limit. You need not need to remember anything extra other than this. Now friends, let's switch our attention to the next topic, right? Let's dive into managing credit and settlement risk in treasury, right? So friends, how do bank manage credit and settlement risk using exposure ceiling limit? Let's understand. So it might sound technical, but don't worry, I have got you covered in all the simplest way. The first thing we have is called fixing the exposure limit, which means exposure limit are set to cap the risk for bank, financial institution, mutual fund, primary dealer, and forex and security broker. In short, any party your treasury deals with must have a well-defined exposure cap, right? So any party your treasury deals with, it must have a exposure cap. That is the point. Second thing is types of credit risk. Then look at it, very, very important. So credit risk is not one dimensional. Rather, it includes default risk. Default risk is one part of the credit risk, which means the borrower bank might fall. Right. Another kind of credit risk, is called price risk. You see this price risk. Price risk means what? For example, repo. Let's take the real case of repo. So repo, repo might carry risk if the price drop. Right. Weak bank have failed before. So treasury team avoid concentrated lending and spread the risk smartly. Yes, concentration risk should be avoided. Right. We should spread the risk. Then comes the settlement risk. Yes, settlement risk is also very, very important part. Let me show you where it is written. Here you can see on the right side. This is what we are talking about, settlement risk. So friends, even if party does not default, the deal might still go wrong due to, right? Suppose party is not defaulting, but even then also the deal may go wrong. Why? Because delayed delivery or payment. It's called DVP, delayed DVP. This is called settlement risk. You know what is the meaning of DVP? Delivery versus payment is ideal but not always possible. Second thing is, government security, GSEC. So GSEC is settled through RBI using SGL fund. Remember it, SGL, sovereign government bond. So friends, SGL, right, plus fund. So this is how GSEC is handled. This is called settlement risk. Corporate security, it is settled via CCIL. Right. So this is settled by a CCIL, Clearing Corporation of India Limited, or other depository. If we talk about the Forex, so time zone gap create a lag risk, right? And if we talk about PVP, that is payment versus payment via CLS, it reduces the foreign exchange. So remember this technique, DVP deal, right? Not always feasible. GSEC done through SGL, corporate security settled via CCIL, Forex time zone gap causes settlement lag risk, and PVP via CLS. Right. If you look at the purpose of this exposure ceiling limit, right? What is the purpose of this limit? Let's look at it on the right side. So basically, the exposure limit are like your shield. They control credit risk and counterparty risk. Remember, we have just talked about credit risk. So they keep credit and counterparty risk in check. Also, they promote diversification, and they most importantly they prevent the concentration risk, because putting all your egg in one basket not smart in treasury. And the last we have is called the monitoring and review responsibility. Who monitor it? Just like we have seen, the stop limit is monitored by back office, but in the case of this exposure ceiling limit, it is monitored by setting limit is just step one. Enforcing them is the key. So this job lie with the back office and the mid office. And yes, there is a mandatory annual review to ensure everything stays in check and up to date. So exposure ceiling limit are not just policy; they are the backbone of treasury risk management. They help institution breathe easily while handling large volume with multiple players. Friend, if you are interested in such kind of content for each and every units of CAIIB, you can enroll in our crash course, which hardly costs ₹650 for the entire 5 subjects. And in the crash course, we are covering only thing that matter. If you want to get more detail, feel free to WhatsApp me on this particular number. Right? Please save this number for any query related to the CAIIB. Now friends, let's look over to the next slide we have. So friends, we are diving into one of the most misunderstood yet powerful tool in the bond analysis, that is called duration. Right. So duration simply tells us one thing: how sensitive is a bond to the interest rate change. That is what duration tells us. You see the definition here, right? So the definition is quite simple. It shows you the interest rate sensitivity, which means how sensitive our bond to the interest rate change. If you are in investment business, especially dealing with bond, you must know how even a small rate move can shake up your return. That is exactly what duration measure. But the question is, why duration? Because let me talk about why duration. I think here we are. Why duration? You can see why duration is necessary. Because duration gives us a weighted average life. It gives us a weighted average life of a bond cash flow. Right? It gives a weighted average life of bond cash flow. Right? It helps calculate the present value of the future payment. Super useful when comparing bond or predicting impact of rate change. But if you talk about the limitation of YTM, that is called yield to maturity, a common mistake thinking that YTM is equal to risk. No, YTM does not capture bond maturity impact. Right? YTM is not as the risk. Duration matter. Right? So it does not capture. Let me show you. It does not capture maturity. Right? It coupon effect, or how sensitive the bond is to rate change. That is why duration, why YTM ignored the sensitivity. That is why duration is used here when it comes to risk analysis. YTM is not sufficient. Right? If you link it with the YTM, here you can see on the right side how duration is linked to the YTM. So duration and YTM goes hand in hand. To calculate duration, you need YTM, that is called yield to maturity. So YTM help discount each cash flow to get the bond present value. Yeah, right. Because YTM is the rate at which you do the discounting. But duration, it goes one step ahead by showing how much a bond price will change if interest rate change. Right. So this duration tells us, this duration shows us how much the bond price will change if the interest rate change. Right. So it goes one step ahead. And YTM is used for discounting purpose. This is the rate at which you discount the bond to get the present value of the bond. If we talk about the nature of the bond, so here you can see on the right hand side, let me show you. This is the nature of the bond. Right. If we talk about it, so basically different bond, different behavior. We have government bond, we have non-government bond, bill, debenture, right? So bond can be priced at par or discount or premium depending on the market yield. Now if you talk about the price yield relationship, here you can see at the bottom. So what is the price yield relationship? It is quite simple. When yield increase, price decrease. When yield decrease, price increase. So the in this inverse relationship form the basis of most bond trading strategy, and duration help and quantify that effect. If you look at the market dynamic on the right, on the left side, what does it mean? So basically, real world impact bond price move with maturity, right? And also interest rate trend. Why? Because when rate is increasing, price is decreasing. When rate drop, price increase. So duration help you navigate this market wave confidently. And if you talk about the yield, here you can see the yield. So yield, what does it mean? So let me show you. So if you talk about the yield, so yield is the actual return you are getting. It's not just interest. It includes coupon, it includes price gain or loss, it includes maturity payout. It is also called IRR, internal rate of return. So yield shows your cash flow are really worth. So what we learned from the discussion is that duration is your financial compass in the bond world. It tells you where you stand, how far you can go, and what bumps you might hit along the way. So whether you are managing a portfolio, analyzing investment, always know your duration. That is the role of duration here. Right. Now friends, let's switch to the next topic that we have. The next topic is understanding modified duration and its application. Yes. So friends, if you have already got a grip on basic of duration, let's now step into more refined cousin, that is called modified duration. Think of like duration 2.0. More precise, more predictive, and incredibly useful for investor and risk manager alike. So modified duration is calculated as duration divided by 1 plus yield. Why is this useful? Because it tells us exactly how much a bond price will change for every 1% change in the interest rate. For every 1% change in the interest rate, how much the bond price will change. This is what is indicated by the duration. So suppose MD is equal to 5, right? So and yield rise by 1%. So what will happen? The bond price will fall by 1%, right? Very much clear. Now friends, if you look at the convexity adjustment, you can see here. So modified duration is first order derivative. It means that it shows the initial impact of rate change. Remember, this modified duration is called the first order derivative, right? Because it shows the initial impact of rate change. But for bigger non-linear move, we had a convexity adjustment, which is called second order effect, right? In simple term, duration is a speedometer, while convexity means steering adjustment on the curve, right? So modified duration, remember, it is the first order derivative, right? Now the second thing we have to study is the application. So let's say interest rate rise by just 5 basis points. So you can use modified duration to quickly estimate the bond price drop, because interest rates increase, bond price will drop. You know it very well. So using modified duration, you can know how much bond price will drop if interest rate rise by 5 bps, right? So no need for complex spreadsheet, but there is a limitation also. That it work accurately for a small change in the rate. Why? Because it assumes that yield curve is linear. Yes, this is the assumption that it makes, that yield curve is linear, which is rarely true in the real world. For bigger swing, you need convexity also, right? Convexity is also required. And if you look at the duration in finance, so this is where modified duration truly shines. It helps bank and financial institution manage the difference between assets and liability duration. You can see through this through this tool, modified duration, the institution, financial institution, can manage the asset duration and liability duration difference, right? It is a key metric in macro hedging, helping bank interest rate risk across the entire balance sheet. So modified duration gives you a sharper, a smarter way to measure the bond risk. It blends math and market sense into a tool that is both practical and powerful. So the next time someone say interest rates are changing, you will know exactly how much impact it is going to have, right? So that is all we need to understand from this particular chapter. Nothing else, nothing extra is required, right? So if you want such kind of PDF videos, please WhatsApp me on this particular number, right? We have all the study material available for CAIIB. You can install our app also, JIB and CAIIB made simple, in the description section. Thank you.